Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of it should be relied upon as any form of advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. Is just general in nature only. I want to start with this chart, and this chart I think is really important to understanding the CPI debate and where we are going in the US, because that is clearly the biggest game in town at the moment with regards to what the inflation outlook in the US will be over the next 2 to 3 years. And very clearly you can see there's the yellow line there, or the orange line, along with the blue line, which is the line of best fit that I've put in there, and then I've highlighted the kink. And the kink is really important because this is where the transitory nature argument comes from. We had a very big pullback last year for obvious reasons. COVID impacted everything it did across the globe, not just in the US. And that's why those blue bars at the bottom show that year on year, we're having some pretty astounding figures. In fact, if you look at the 5% that we actually saw on the headline figure, that was some of the best that we've seen since the 1980s. If you look at the month on month, it's the same. If you look at the 2 month on month figures, it's also the best since the 80s. And then on the core figure, the year on year and month on month figures were the best we've seen since June 1992. But again, looking at that kink and what that chart shows you is that it will slowly but surely roll off. However, there's something else on that chart that you should be looking at that is absolutely key to maybe understanding that the Fed is going to be slightly behind the 8 ball with this call. The line of best fit shows that even with the kink, it's above trend. And yes, there's no doubt that you can see that the used car sales, which grew by 7.4% to go with 10% the month before, is a transitory figure, and you did see that across a lot of things like that. But there's also no doubt that things like services, things like employment are on the up, and they're more structural, and therefore inflation's coming. You can also then make the argument that if you take these figures here that we saw for the CPI read last Thursday and have a look at what that would mean for the 25th of June when PCE is out, the personal consumption one that realistically matters to the Fed, you can make an extrapolation that it's likely that there'll be about a 0.5% month-on-month gain and a 3.4% year-on-year gain. The Fed believes that inflation on a PCE level will be at 2.2 by December. Something pretty drastic is going to have to happen to slow that right down. So they're either going to be materially wrong, or they're just going to upgrade their forecast and look through it. That's the big question. And realistically, the answer to that is that if that is the case, the market doesn't care. And I find that very interesting, because the reactions in the US dollar were initially what you would expect, which is that they jumped to the upside, and then very quickly they latched onto the bond market, which fell on the yield side. So people were actually buying in and took it with it. I find that really interesting, and I'm not sure that that's necessarily a good thing that the market has done what it's done. There is genuine risk here that the US dollar will find strength because it has to. Yes, there's an absolute boatload of stimulus in the market, and yes, I know that the federal government stimulus is still coming thick and fast, and therefore it's flooding the market. But the heat that is now very much clearly becoming real inside US markets has to become an attraction. And that US dollar, which is quite weak over the last 6 to 8 weeks, really is becoming quite an interesting conundrum for all and sundry.